how important is it to sustain the growth in the United States of America to get tax reform from this administration?
Well, let me just make sure I get the context right here. So at the beginning of the year, after 10-year Treasury rates went up, as we were putting together a forecast, we made an assumption that the rates went up in part because the administration was likely to implement more spending, tax reform, things like that. And so that would support stronger growth. And so we added a bit of that into our outlook. And so we had growth in the 2.25% to 2.5% range over the next couple of years. Now, the way things have turned out, we probably don't have as much of that in our outlook, and maybe it's a little further into the future. But basically, the economy is pretty strong in the U.S., and so there are a lot of organic reasons why I'm expecting growth of 2.25% to 2.5%, and the global economy is better too, as we were talking about.
So if we have that kind of an economy, we've had some rate hikes from the Federal Reserve. How would you describe the Fed funds rate right now? Would you say, Manus, I think we are accommodative at the moment? How would you describe the status quo at the moment?
So I think that's right. I think, going back to December 2015, we've raised the federal funds rate 4 times by 100 basis points. And so we're now targeting a range for the funds rate between 1 and 1/4%. I think that's still accommodative. We still have a ways to go in terms of getting inflation up to our objective. It's disappointingly low, I would say. Core PCE is under 1.5% year over year. I think pretty much all of us are expecting it to move up, but I'm thinking it's going to take a little bit longer to get up to 2% than many people, and so we might need a continued accommodative stance. We're accommodative now. I think from here on out, every rate increase is going to get closer to that line where I'm not as sure that it's going to be leading to inflation moving up. And so I think those are judgments that we have to come to before the next rate increase.
From the data that you've seen so far, where do you stand on a December hike?
It's too early to say. I do think that the inflation data have been disappointing. I understand. I've read the arguments. I've heard them that it's likely due to transitory factors. There certainly have been a number of those in the U.S. I would say that, low inflation is a global environment, and so the whole world is dealing with transitory effects. I'm sure that there's some of that is true too. I'm really nervous that inflation expectations are low. They've been low for quite some time. In our FOMC statement going back to October 2014, we've been regularly calling out that market measures of inflation expectations have been moving down, that they're low. They continue to be low, even though they bounced back a little bit after the election. And I think survey measures are also weaker than sometimes we talk about.
Expectations are incredibly important. The 5-year, the forward expectations of where rates are going to go. That's the benchmark that I look every day when I pull it.
Too.
Good. I'm glad I'm on the same page. How does the Fed push those expectations? What more should or could you do to push the expectations up?
Well, this is a big think question, really. So this really comes down to how are we talking about meeting our policy objectives? I think that we need to be basing our decisions on outcome-based monetary policy. We need to be very clear. We are in telling everybody we are supposed to be supporting full employment and price stability. The unemployment rate's quite low at 4.2%. I think wage growth could be stronger. So I think we're, pretty close to full employment, but if stronger wage growth would reinforce that idea better. But getting inflation up to 2% is something that's very important, and moving inflation expectations up by just talking about it, making sure we're willing to go above 2% if that, actually happens, because we've got a symmetric inflation objective. That's my opinion. We do have a symmetric inflation objective. I think we should be willing to push inflation above 2% because we should be spending some time above 2%, just like we've spent quite a lot of time below 2%.
Can I ask you, can I just push a little bit harder on that? What is running hot Evans style, Chicago style? Is it 2.5%? Is it towards 3%? Is it the ability to let it run, let it breathe?
Well, I don't think we should fear 2.5% inflation. If we're trying to get inflation up to 2%, we get there quicker than we thought, and we get to 2.5. 2.5 is not inconsistent with a symmetric 2% inflation objective. We should be spending time above 2%, just like we have been spending time below that. We should be averaging 2% going forward over some period of time, and if we started from a higher than 2% range, then we would be pushing policy to a slightly restrictive point and expecting it to come down over some period of time.
You touched on, obviously, some of the other metrics there, which is the unemployment rate, the natural rate of unemployment. How low can she go? And okay, we've about 5 minutes left, so I don't think we're going to answer that question in the next 45 seconds. But for you, the propensity to get to 4%, to get to sub 4%, is there a risk if that keeps dropping?
Well, I definitely think that if the labor market continues to be very strong, if unemployment continues to fall, if it falls below 4%, that's a sign that there should be mounting inflation pressures. Now, we do have to realize that the technical aspects of this, the Phillips curve is really quite flat, and so we probably won't see inflation move up very much because of that. You know, it might take something like 3.5% before you'd really see inflation pick up from a strong labor market. But on the other hand, there's a risk there. And so I understand why, we don't want to risk inflation getting out of control. I would just say that if we're going to have a 2% inflation objective, we have to be willing to spend time above 2%. That might be 3.9% unemployment and inching the funds rate up gradually the way that we've talked about.
Can I ask you, the single most talked about topic, my colleagues in the United States have been talking about it before we came to talk to you. You and I touched on it, is succession planning. So let's go at it a slightly different way. What does the Fed need in its next phase of leadership? You've lived under Bernanke, you've lived under Janet Yellen, you've also had experience of Greenspan in the room. Charles Evans, what does the Fed need in terms of leadership going forward for successful succession?
Well, I think we've been extremely well served by the leadership of the Fed chairs that we've had, the ones that you mentioned. I think we need thoughtful discussions. I think we need committee members who bring their best thinking to the table, different viewpoints. The viewpoint that I'm expressing right here is different than many around the table. I think we benefit from everybody thinking, what are the risk scenarios we might be facing? What is it that could lead inflation to be above 2%, Evans, when you say it's okay? How about this circumstance where you're going to be okay with that? Well, let's think that one through. So we need to challenge each other, and so we need leaders and presidents so that we, have that give and take discussion.
Can I ask that full compliment? We've debated that a lot on Bloomberg, that there's not a full complement, and to that end, maybe, and you help me with this, maybe there's a bit of a holdback in terms of being able to make bigger decisions about the way forward.
No, I think we've been running the policy decision making the way that any committee would. We have been very thoughtful. Ben Bernanke, Janet Yellen worked very closely. Chair Yellen came in, and the balance sheet. We need to get that to a point where it starts to roll off and we get back to a normal balance sheet. She has begun that. That is a very important accomplishment. I think that we're going to be well served by getting this started. It will impart a small amount of additional restraint, but we've got our other policy tool, the federal funds rate, which would be the one that will vary as to whether or not we need more accommodation or less accommodation. And so I think that we're going to be very well served by that strategy.
The bond traders will literally be waiting for the answer to this. The balance sheet reduction, $4.25 trillion in size at the moment. In your mind, remaining accommodative to the US economy, when you scale back the balance sheet, the new level of where that balance sheet will be? Many people are saying to me it will be bigger than it was pre-crisis. Is there a bandwidth at the Chicago Fed where you think the balance sheet size will be post-reduction?
Yeah, I think we don't know the answer to this question yet. So we're going to learn a lot about how the economy works, how the markets work, as our balance sheet runs off, and how it interacts with our funds rate tool. I don't think we're going to be surprised at the interactions with our funds rate tool, but I think we're going to be learning as the assets roll off and we get down. What is the appropriate size for the balance sheet? It's going to be higher than it was in 2007. It has to be. The economy is a lot bigger,
Yes.
and so it's going to be bigger. We have some policy, strategic decisions to make. Do we want to provide additional reserves to achieve a bit more of a financial stability goal so that there's more liquidity in place for banks, or do we want to go back to a previous system where we had scarce reserves and we had an active Fed funds market? I doubt it's going to be that latter. I think it's probably going to be one with a bit more reserves, but how large that will be, we still have to figure that one out.
We've got to figure that one out. Financial stability, we touched on this in the discussion downstairs. I quoted Janet Yellen to you. It's in our stories. But are you concerned about financial markets and risks? I think the line that I've written down here, there's an increased risk tolerance. Janet Yellen cited it. It was back in June. Lael Brainerd cited it. Is there any canary in the market coal mine that unsettles you at all?
I think we always have to be mindful of how the financial markets are working, how much risk-taking is proceeding. To some extent, we need risk-taking in order to get more investment out there into the right places so that the economy can grow better, more robustly. We need to be careful that there's not, excess exuberance. We need to be thinking about whether or not our policies are adding to this. I do think that we have to make sure that we're delivering on our dual mandate objectives of full employment and price stability. But, we need to look for signs of exuberance. And so 4 times a year, we have a committee presentation where we look at that. And we think the risks are moderate at the moment.
So no irrational exuberance at the moment in the market for Chicago Fed?
You can see a lot of, you can rationalize a whole bunch of things, right now.